When I look at the way most investors behave, the first big mistake I see again and again is this obsession with chasing quick gains. It's almost human nature. We all want results fast. We want to see the graph shoot up tomorrow. We want our portfolio to double overnight. And we believe that if we can just find that one hot stock or cryptocurrency or some new fancy thing everyone is talking about, we'll be set for life. And yet history has shown us time and time again that this is exactly the path that destroys wealth. Think about it for a moment. If you buy something only because it's gone up recently, what are you really doing? You're not investing, you're speculating, you're not studying the business, you're just following a price trend. And trends are dangerous because they don't tell you the reality of the business. A stock can rise 20%, 50%, even 100% in a short period, but that tells you nothing about whether the company behind it is durable, whether it will even exist 10 years from now, or whether you bought it at a price that makes sense. The irony is that the stock market is designed to transfer wealth from the impatient to the patient. Yet most investors fall into the trap of impatience. They look at the ticker every day, every hour, sometimes even every few minutes. They panic when the market goes down and they become euphoric when it goes up. But what they forget is that behind every stock is a business. If you don't understand that business, if you don't know its cash flows, its competitive advantage, its long-term prospects, then you're simply gambling. And gambling is exactly what 90% of investors are doing, even if they don't admit it. Let me share a small example. Imagine you had invested in Coca-Cola in the 1980s. It wasn't a flashy company. It wasn't the next big thing. In fact, it was already over 100 years old. Yet the people who bought Coca-Cola shares back then and held them patiently without worrying about every market swing multiplied their wealth many times over. They didn't need to find the next hot startup. They just needed to own a great business and give it time. That's the secret the majority of investors miss. Now contrast this with the behavior we see so often today. People rush into IPOs because they hear the hype. They pile into tech companies with no profits because everyone else is doing it. They buy when it's popular and they sell when it's painful. And then they wonder why their returns look so different from the returns of the great investors. It's not that the opportunities aren't there. The opportunities are always there. The problem is that most people can't sit still long enough to let compounding do its work. Compounding is the eighth wonder of the world. But compounding needs time. It needs patience. It doesn't reveal its magic in 1 year or 2 years. It reveals itself over decades. A dollar invested with patience can turn into 10 or 100. But that requires you to resist the temptation of quick profits. It requires you to stop chasing what's moving today and start owning what will endure tomorrow. I've met countless investors who say, if only I had bought Amazon 10 years ago, or if only I had held onto Apple instead of selling too early. And that's exactly the point. It's not about finding the next Amazon. It's about recognizing that once you own a great business, your job is to stay with it through thick and thin. The biggest enemy isn't the market. The biggest enemy is our own impatience. When you constantly chase quick gains, you're not just risking losses, you're also giving up the chance to benefit from true wealth creation. You might make a little money here and there, but you'll miss the exponential effect that comes only from holding great businesses for the long haul. That's why 90% of investors get this wrong. They're running a sprint when investing has always been and always will be a marathon. So the first lesson is simple. Stop chasing what's hot. Stop looking for shortcuts. Focus instead on finding businesses that are simple, understandable, and built to last. Buy them at a fair price, and then have the courage to sit tight while the rest of the world rushes around you. If you can do that, you will already be far ahead of the 90% who keep repeating the same mistakes. And that's why the market rewards patience more than brilliance. Another mistake that almost every investor makes, and one that often turns out to be fatal, is ignoring risk management. Everyone talks about how much money they want to make. Everyone is obsessed with returns, but very few stop to ask the more important question, how much could I lose? In investing, avoiding losses is far more powerful than chasing gains. And yet, most investors don't think this way. The problem begins with mindset. Most people approach the market with a gambler's mentality. They think, if I just take enough shots, one of them will hit big. And sure, once in a while, a gamble pays off. But over a lifetime, gambling destroys far more wealth than it creates. What smart investors understand is that the first rule is not to maximize returns. The first rule is to protect capital, because if you lose half your money, you don't need a 50% gain to recover. You need a 100% gain. And those recoveries don't come easy. Let me give you an example. Imagine two investors start with 100,000 each. One of them loses 50% in a downturn and is left with 50,000. The other avoids the big loss and stays flat at 100,000. The one who lost money now needs to double his 50,000 just to get back to where he started. That could take years, even decades. The other investor who avoided the loss can compound uninterrupted. That's the difference risk management makes. It doesn't show up in flashy headlines. It doesn't make for exciting stories at cocktail parties, but it makes all the difference over the long run. What does risk management really mean in practical terms? It means never putting yourself in a position where a single mistake can wipe you out. It means avoiding leverage when you don't fully understand it. It means not concentrating all your wealth in one idea you think can't fail. It means buying with a margin of safety, which is just another way of saying you only invest when the odds are strongly in your favor. The truth is, most investors forget that the future is uncertain. Businesses change, markets shift, unforeseen events happen. You can be right about a company's long-term potential and still lose money if you overpay. You can be right about a sector and still lose money if you size your bet too aggressively. You can even be right about the market overall and still get wiped out if you don't leave yourself room for error. That's why humility is so important in investing. Risk management is nothing more than an admission that we don't know everything. It's a recognition that the world is unpredictable, and our job is to build in enough protection so that even when we're wrong, we survive to fight another day. Think about how most people behave during bull markets. They become euphoric, they take on more risk, they assume the good times will never end. And then when the inevitable downturn comes, they're completely unprepared. Their portfolios are over-leveraged, their assets are overvalued, and they're forced to sell at exactly the wrong time. If instead they had managed risk carefully, kept some cash, avoided overpaying, and stayed disciplined, they would not only have survived, but thrived, because downturns are when the best opportunities appear. Risk management also requires emotional control. The stock market is a machine that constantly tests your discipline. When prices fall, fear takes over. When prices rise, greed takes over. If you don't have a framework to manage risk, you'll be pulled back and forth by your emotions, and emotions are the worst possible guide for decision making. Having a margin of safety, having rules about how much you're willing to risk, these are the guardrails that keep you from going over the cliff when emotions are high. Let me share a simple principle that can change the way you invest. If you avoid the big mistakes, the returns will take care of themselves. You don't need to find the next 10 bagger. You don't need to outsmart everyone else. You just need to stay in the game. And the only way to stay in the game is by managing risk. If you can avoid the permanent loss of capital, if you can avoid being forced out of the market when everyone else is panicking, you will have opportunities others can't even dream of. So when you think about investing, don't just ask, how much can I make? Ask, how much can I lose? And can I live with that? If the answer makes you uncomfortable, don't invest. Wait until the odds are overwhelmingly in your favor. Wait until the price gives you a margin of safety. Because in investing, survival is success. And that is why protecting the downside is far more important than chasing the upside. Another reason most investors fail is because of overconfidence and the herd mentality. These two often go hand in hand. When markets are rising, people begin to believe they are geniuses. They think their success is the result of skill, when in reality, it might just be luck or simply being carried by a rising tide. That overconfidence leads to reckless decisions, overtrading, taking on more risk than they should, and convincing themselves they can time the market perfectly. And then when they look around, they see everyone else doing the same thing, so it feels safe. But that's the danger of the herd. When everyone is running in the same direction, it feels comfortable, but comfort in markets usually comes right before disaster. The irony is that the market is designed to punish overconfidence. The moment you start to believe you can predict its every move, it will remind you how little control you truly have. Many investors don't just make this mistake once, they repeat it over and over because it feels so good to be part of the crowd. There is a certain reassurance in doing what everyone else is doing. If you succeed, you feel validated. If you fail, at least you're not alone. But following the herd almost always guarantees average results at best, and at worst, it leads to devastating losses. Consider the dot-com bubble. In the late 1990s, everybody was talking about internet stocks. Companies with no revenue, no profit, and no real business model were being valued in the billions simply because the future was the internet. And yes, the internet was the future, but most of those businesses were worthless. Still, millions of investors poured in, telling themselves that this time was different. They weren't making rational decisions. They were swept up in collective euphoria. And then almost overnight, the bubble burst. Trillions of dollars in wealth vanished. Investors who thought they were visionaries discovered they were just part of the herd running off a cliff. The same pattern repeats across history. The housing crisis, the cryptocurrency bubbles, even speculative crazes in commodities, all of them are fueled by the same psychology. People stop thinking independently. They stop asking, does this make sense? Is there real value here? Instead, they look at what everyone else is doing and convince themselves that safety lies in numbers. But in investing, safety is rarely found in numbers. It's found in truth, in fundamentals, in reality. And reality doesn't care how many people believe in a story. Overconfidence adds another layer of danger. Investors often assume they can get in before the herd and get out before it crashes. They think they're faster, smarter, and more disciplined than the rest. But the market doesn't work that way. Timing is nearly impossible to get right consistently. Even the most brilliant investors admit they cannot predict short-term movements. Yet individual investors convince themselves that they will know the exact moment to exit. And in chasing that illusion of control, they set themselves up for failure. The antidote to both overconfidence and herd mentality is humility. Humility in admitting that we don't know everything. Humility in accepting that the market will surprise us. Humility in realizing that what everyone else is doing is irrelevant to our own decisions. True investors don't look to the crowd for validation. They don't measure their success by how many people agree with them. They focus instead on whether the business they own is solid, whether the price they paid makes sense, and whether they can hold it through thick and thin. One of the hardest things in investing is to stand apart from the crowd. When everyone is buying, it takes courage to wait. When everyone is selling, it takes conviction to hold or buy more. But those are the moments that define success. If you follow the herd, you will always buy high and sell low because that's what the herd does. The crowd buys in at the peak of excitement and sells at the bottom of fear. If you want to be in the 10% who succeed, you have to do the opposite. You have to train yourself to act with logic when others are acting with emotion. It's important to understand that markets are essentially giant amplifiers of human behavior. They reflect our greed, our fear, our impatience. And when those emotions get magnified by millions of people acting in unison, bubbles form, crashes follow, and wealth shifts from the reckless to the disciplined. If you can resist being pulled into that cycle, if you can remain rational when others are irrational, then you will already have an enormous edge. At the end of the day, overconfidence and herd mentality are just two sides of the same coin. They both come from the same place, the desire to feel certain, to feel safe, to feel like we know what's going to happen. But markets don't reward certainty. They reward discipline, patience, and independent thinking. If you can cultivate those qualities, you will not only avoid the traps that most investors fall into, but you will also position yourself to take advantage of the opportunities that appear when the crowd inevitably gets it wrong. The final mistake that I see most investors making, and perhaps the most fundamental one of all, is investing in companies they do not truly understand. It amazes me how often people will put their hard-earned money into a stock without having the faintest idea what the business actually does, how it makes money, what risks it faces, or whether it has any real future. They buy simply because someone on television recommended it, or because a friend told them it was a good pick, or because the price chart looked attractive. This is not investing. This is blind faith, and blind faith has no place when it comes to your financial future. The reality is simple. When you buy a stock, you are not buying a lottery ticket. You are buying ownership in a business. You become a shareholder, which means you own a piece of that company with all its strengths and weaknesses, all its risks and opportunities. If you don't understand the business, how can you possibly judge whether it is worth owning? If you can't explain in simple words how that company makes money, then you shouldn't be putting your money into it. Think about it like this. Would you buy an entire small business, a restaurant, a car wash, a retail store, without ever looking at its operations? Would you buy it without knowing its costs, its competition, its customer base, and its long-term prospects? Of course not. Yet somehow, when it comes to the stock market, people do exactly that every single day. They treat stocks like abstract symbols rather than real businesses. And because of this, they get caught in traps, buying companies with flashy stories but no substance, or piling into industries they don't understand only to be surprised when reality doesn't match the hype. History is full of such stories. During the tech bubble, many people bought internet stocks because the word .com was attached to them without understanding whether the business models made sense. Most of those companies collapsed. During the housing bubble, investors rushed into financial firms with complex structures and instruments they couldn't possibly explain. When the system unraveled, they discovered that complexity often hides fragility. And more recently, people have been rushing into speculative assets, cryptocurrencies, NFTs, and countless other things without stopping to ask a simple question: does this have real, lasting value? Understanding a business doesn't mean you need to be an expert in every detail. It means you need to stay within your circle of competence. That circle doesn't have to be large, but it has to be clear. If you know something about consumer products, then focus there. If you understand banking, then study banks. If technology is outside your grasp, there is no shame in admitting that and staying away. The problem is that most investors feel compelled to play in every field. They see others making money in an area they don't understand and feel they're missing out. That fear of missing out pushes them into decisions they shouldn't be making. But success comes not from playing everywhere. It comes from knowing yourself, knowing your limits, and being disciplined enough to stick to what you understand. There is enormous power in simplicity. The best investments are often in businesses that a child could explain. Selling soft drinks, operating insurance, running a railroad. These are not mysterious enterprises, yet they have created tremendous wealth for long-term shareholders because they were stable, understandable, and built to last. On the other hand, the businesses that require complicated explanations that leave you confused after an hour of reading are usually the ones that come with hidden risks. If you don't understand it, don't touch it. That one simple rule could save investors from most disasters. Another reason understanding matters is because it gives you the conviction to hold through difficult times. Every business will face challenges, recessions, competition, regulatory shifts. If you don't understand the company, you'll panic at the first sign of trouble and sell at exactly the wrong moment. But if you know the business deeply, if you understand its strengths and long-term prospects, you can stay calm, hold on, and often use downturns as opportunities to buy more. Knowledge breeds confidence, and confidence prevents costly mistakes. The truth is, most investors lose money not because they pick the wrong businesses, but because they don't truly know what they own. They sell too soon, or they hold on to failing businesses for too long simply because they never understood them in the first place. By contrast, the minority who succeed take the time to study, to think, to really know the companies they invest in. They read the reports, they study the competition, they ask the hard questions. And because of that, they avoid being blindsided. So the lesson is very straightforward. Only invest in businesses you understand. Keep your circle of competence small but deep. Be honest about what you know and what you don't. There are thousands of companies out there, but you don't need thousands. You only need a few good ones. And if you focus on the ones you can understand with clarity and confidence, your chances of long-term success rise dramatically.